Hello and welcome to another Deep Value video. Today, taking an in-depth look at Palantir Technologies, ticker symbol PLTR. We'll dive into the financial metrics, assess the company's growth, and ultimately try to find its fair buy price. Palantir Technologies is an American public company that specializes in software platforms for big data analytics. The company has three main projects: Palantir Gotham, Palantir Foundry, and Palantir Apollo. Gotham is an intelligence and defense tool used by militaries and counterterrorism analysts. Its customers include the United States intelligence community and United States Department of Defense. Palantir Foundry is used for data integration and analysis by corporate clients such as Morgan Stanley, Airbus, Lilium, PG&E, and Fiat Chrysler. Palantir Apollo is a platform to facilitate continuous integration delivery across all environments. As of the 4th of November 2024, the stock is priced at $41.9 and the market cap is 93.9 billion. Now let's have some key valuation metrics. The company's price to earnings ratio stands at 247 and the price to cash flow ratio is 132. The median PE over the past 10 years was minus 32, showing that they have mostly operated at a loss, but now they've turned profitable. Over the past 5 years, the company's revenue has grown by 199.4%, and its bottom line has improved by 136%. In terms of earnings per share, there has been a growth of 108.8%, and notably, the number of common shares outstanding is 2.37 billion, a 311.6% dilution over the period, which is definitely at an alarming pace. Now let's assess the company's liquidity and solvency. The interest coverage ratio is 83, indicating the company's solid ability to handle its debt obligations. The quick ratio, a measure of the company's short-term liquidity, is 5.77, which I believe is the highest quick ratio I've ever seen in my life, and it's extremely good. Then the long-term debt equity ratio and the total debt equity ratio are both zero. This is because of the share dilution. What the founder of the CEO of Palantir did is somewhat ingenious in the sense that the only method he used for financing is share dilution. Um, and by creating so many new shares and putting them on the open market, he basically created a lot of capital for the firm to use, and he basically didn't borrow anything at all. So this does affect the shareholders in the sense that they're being absolutely destroyed by dilution, but it does help the balance sheet of the company. Shifting to the cash flow statement, cash from operations stands at 700 million, reflecting a growth of 531%. Cash from investing activities is minus 2.7 billion, with a plus 12.2000% change, while financing activities are at 200 million, showing a minus 42.7% change over the same period. CapEx has increased by 14.5%, and free cash flow has grown by 1,339% to 660 million. Moving forward, let's look at the return metrics to see how the company is utilizing its resources. The return on equity is 11%. The return on investment can be calculated because they have zero debt. The return on assets is 8.7%, and most importantly, the return on invested capital stands at 30.3%. Finally, let's find the acceptable buy price. The first method is conducting a discounted cash flow analysis by using a discount rate of 9%, a revenue growth rate of 15% for 10 years, and a perpetuity growth rate of 2%. We get a fair value of $11.12. Secondly, using a multiple variation of 20 times earnings, operating cash flow and 25 times free cash flow, we get a fair value of $5. Thirdly, the endless price target is $27.8. And putting it all together, we arrive at an intrinsic value of $14.6. Using a 15% of margin of safety, you get an acceptable buy price of $12.4, suggesting our stock at the current levels is extremely overvalued. To wrap up my analysis, I rate Palantir as a sell. Now, I know that the people watching a commentary on Palantir are probably the people that don't really care that much about valuations, but if you even try to look at this through fundamental point of view, this is a company that is literally trading in the hundreds when it comes to PE and price to cash flow and free cash flow. I'm not sure how you can even justify owning this company. Even if they basically did 20% growth for 15 years with a 30% operating cash flow margin, which they'll never reach, they would still be overvalued. This is absurd. I'm not sure how I could even defend this company. What they definitely deserve is, well, the CEO deserves is a point for using shares to protect the balance sheet from debt, because most of these companies that grow so fast accumulate a lot of debt. But it is very good what he did with the share dilution, but not if you're a shareholder. If you're a shareholder, then, and if even if he stops right now, imagine if you owned this company 4 years ago, now you own a fourth of what you owned before, in terms of percentage. So this is not really that good. Now, I hope some of you out there that own Palantir see this as a sell side, especially because it increased its share price to 100% over the last year. So I would rate it as a sell. Now, if when it comes to a buy, I think it deserves a buy at around sub, I don't know, sub 15, sub 13 levels. So a long way down. Thank you for watching. If you found this video helpful, please like and subscribe for more developments. See you in the next video. Bye.